You've got a 3.5% mortgage, and you just saw your dream house come on the market across town. Ever wonder if that great mortgage rate you nailed could actually be keeping you stuck? Today, I'll explain portable mortgages like you're 5 years old. By the end, you'll understand whether this idea could set millions of homeowners free or just create a whole new set of problems. Most people think a mortgage is tied to a house. You borrow money to buy this specific property at this specific address. The house is the collateral. The loan stays with the house until you sell or refinance. But what if that's backwards? What if your mortgage could follow you around like your car insurance? That's a portable mortgage. You lock in your rate, and when you move, you take it with you to the next house. Simple concept, massive implications. Here's why lawmakers are suddenly obsessed with this idea. Right now, millions of homeowners are sitting on mortgages below 4%. They bought or refinanced between 2020 and early 2022 when rates were at historic lows. Then, inflation hit. The Federal Reserve jacked up rates to fight it. Now, new mortgages cost nearly double. Trading a 3% mortgage for a 7% mortgage might cost you an extra $1,000 every month. Economists call this rate lock-in. You're basically a prisoner in your own house. Over 60% of American homeowners have a mortgage rate below 4%. That's tens of millions of families who want to move but can't. Maybe you need more space because you had another kid. Maybe you got a better job 2 hours away. Maybe you want to downsize. Doesn't matter. Moving means financial suicide. So you stay put. And when people can't move, the entire housing market freezes. Here's where it gets wild. When homeowners won't sell, inventory vanishes. There are fewer homes for sale right now than almost any time in the last 40 years. Young families have nothing to choose from. Prices stay high because supply stays low. Portable mortgages could theoretically crack this open. If you could take your 3.5% rate with you, you'd actually consider moving. You'd list your house. Inventory would flow again. The market unfreezes. Now here's what most people don't know. Portable mortgages aren't some brand new invention. Canada has had them for decades. So has the UK. In Canada, if you have 5 years left on your mortgage term, you can sell your house and transfer your existing mortgage to a new one. If the new house costs more, you add a second mortgage on top at the current rate. If it costs less, you port over what you need and pay off the rest. Canadians do this all the time. Their housing market doesn't freeze up every time interest rates spike. So why doesn't America have this? Because our mortgage system is built completely differently. In the US, about 70% of mortgages get bundled up and sold to investors as mortgage-backed securities. Your bank doesn't usually keep your loan. They sell it to Fannie Mae or Freddie Mac or private investors. Those investors bought your specific mortgage expecting payments from your specific house for 30 years. If you suddenly swap that house for a different one, the whole security unravels. The paperwork gets messy. The risk calculation changes. The system isn't designed for portability. Now check this out. There's actually a version of this that already exists in America. It's called mortgage assumption. If you have an FHA loan or a VA loan, the next buyer can sometimes assume your mortgage and take over your low rate. Sounds perfect, right? But almost nobody does it. Here's why. Assuming a mortgage means the buyer has to pay you the difference in cash. If you owe $200,000 on a house worth $400,000, the buyer needs $200,000 up front. Most buyers don't have that kind of cash. They need a loan. And if they're getting a second loan anyway, the whole benefit disappears. True portability would mean you take your mortgage with you. The buyer gets their own new mortgage on the house. Clean break. But that means someone has to pay off your old mortgage when you sell. Fannie Mae and Freddie Mac would need to get their money back. Then you'd immediately reborrow that same amount at your old rate for your new house. This creates a weird accounting problem. Who's fronting the money in between? What happens if your new house is in a different state with different property laws? What if it's more expensive or cheaper? The logistics get complicated fast. But let's say Congress waves a magic wand and makes it all work. Let's say Fannie and Freddie agree to support portable mortgages. The paperwork gets streamlined. The system adjusts. Who actually wins? Homeowners with low rates win big. You'd have freedom again. You could move for a new job or relocate for family. You wouldn't be trapped. Buyers would win because inventory would flood the market. More choices, less competition, maybe even lower prices as supply catches up. Here's the problem nobody talks about. Banks might hate this. Right now, every time you move, banks get to issue a brand new mortgage at current rates. That's profitable. If you port your old cheap mortgage forward, the bank makes nothing. They'd lose billions in origination fees and interest income. They'd fight this hard. Investors might push back too. Mortgage-backed securities are predictable right now. Portable mortgages introduce uncertainty. Investors might demand higher returns to compensate. That could mean higher rates for everyone else trying to get a new mortgage. And then there's the taxpayer angle. Fannie Mae and Freddie Mac are government-sponsored enterprises. They're backed by you. If portability creates chaos in the mortgage market and defaults spike, guess who pays? Some housing experts worry that letting people port mortgages could create hidden risks. What if someone ports a mortgage to a house that's overvalued? What if the old rate makes a house seem affordable when it's really not? The system could get messy fast. Those risks don't show up until the next recession hits. There's also a fairness question worth considering. Portable mortgages only help people who already own homes and already locked in low rates. If you're a renter trying to buy your first place, this does nothing for you. You're still stuck with 7% rates. Some critics say this just helps wealthy homeowners get wealthier while renters stay locked out. It could actually widen the gap between owners and non-owners. But supporters say the alternative is worse. Right now, the market is broken. Families are trapped. Inventory is gone. Young buyers are giving up entirely. Doing nothing means accepting a frozen housing market for years or even decades. Portable mortgages aren't perfect, but they're better than the mess we have now. They'd restore mobility. They'd increase supply. They'd give millions of families their lives back. Here's the reality. Portable mortgages aren't happening next month. This would require Congress to pass new laws. Fannie and Freddie would need to overhaul their entire systems. Banks would lobby hard against it. The mortgage industry would need years to adjust. Even if lawmakers introduced a bill tomorrow, implementation could take a decade. And depending on who's in power, the whole idea might get shelved entirely. But the conversation is happening now because the pain is real. Homeowners feel trapped. The market feels broken. When millions of voters are stuck in homes they've outgrown, politicians start paying attention. Some states might experiment first. Some lenders might offer limited portability as a competitive edge. The idea is out there. Whether it actually happens depends on how much pressure voters put on lawmakers and whether the mortgage industry can adapt. So here's what I want to know. Would you support portable mortgages even if they mainly help existing homeowners with low rates? Or should we focus on solutions that help first-time buyers instead? One thing's for sure, the longer we wait, the more entrenched this problem becomes. Every month that passes, another wave of homeowners refinances at higher rates and loses their mobility advantage. Meanwhile, the gap between mortgage haves and have-nots keeps widening. Some economists argue we should let time solve this naturally, as rates eventually come back down. But others point out that could take years, and we've never seen rate lock-in affect this many people at once. The truth is, no one really knows what happens if we just leave tens of millions of families stuck in place for the next decade.